Hey everyone, this is Ivan Delgado, Market Insights Commentator at Global Prime Forex. And in today's webinar, we're going to be talking about a topic that it is of really cardinal importance. And I'm referring to Forex risk management. Risk management applied in particular to trading and Forex, okay, in this case. Now, it might not actually be a fancy term or a sexy topic, risk management, as compared to, entry techniques or how to actually go about, as I said, trading the markets with a particular strategy. But trust me on this, Forex risk management is going to be one of the most pivotal concepts that you will ever learn, okay? So without further ado, let's go and get into the nitty-gritty. Now, the definition of risk management when applied to trading is essentially, the way I see it, is the ability to apply probabilistic techniques to limit the downside risk in your account balance, okay? So therefore, is in a way part of the secret sauce to be able to make profits in a consistent manner in financial markets, okay? Now, it really comes down to apply, as I said, a set of probabilistic techniques or statistical techniques as part of 4 pillars that I'm going to be touching later on this webinar, okay? And these pillars, I should say, combine with the theoretical explanation that we'll go through today in this webinar, will make it mathematically very improbable for any trader to see a significant reduction in the trading account balance over a long enough sample size of trades, okay? Now remember that this is a concept that it is being applied, risk management, in the worlds of poker, blackjack, horse betting, sports betting, whichever endeavor where probabilities are at the epicenter of determining success. Risk management plays a key role, okay? Now, the basics in risk management. We need to understand, first of all, and it might sound a little bit simplistic at first, so just bear with me, because then it's going to get a lot more interesting. You need to understand what is a Peep in the Forex market. A Peep essentially refers to the unit of measure to express a change in a currency pair, okay? So a Peep essentially stands for point in percentage, and it is often used as a measure of the quote in the currency pair. Okay, so understanding the Peep value of your open positions is absolutely essential to keep your risk under control. Now, that being said, we need to make a distinction between what is a Peep and a new term that came about a few years ago, which is the, the small brother of the Peep, which is the Peep head. Now, the quotes in Forex currency pairs used to be comprised, as I said before, of 4 digits, okay? So as an example, if the euro-dollar exchange rate was traded at let's just say 1.10, a variation to quote to 1.1001, so that 0, and allow me just to show you here an example. So 1.10, that would be 4 digits. And if the variation was 1.0001, sorry. So that 0.0001, that is what we understand as 1 single Peep, okay? Now, however, in order to protect the retail trader, nowadays the quote of a currency pair tends to include 5 digits. So the same quote of 1.10 that I've highlighted right there, in the past is now displayed as 1.10 with an additional 5th digit, okay? So you can see here, we can count 1, 2, 3, 4, 5, okay? So we got 5 digits, okay? Now, a change from 1.10 with 5 digits to 1.0 with 5 digits. So that variation is what we then understand as a 1 Peep head, okay? So that's what we understand as 1 Peep head in the Forex market. By adding that extra digit, it really helps to standardize the size of an entry while protecting traders and investors from taking too large bets, okay? So you need to understand a Peep bet as the smallest change in a currency pair by a broker. You need to understand Peep by the smallest change in a currency pair by a broker, only quoting 4 digits, okay? So when that's the case, the smallest change can only be 1 Peep, okay? So if there are brokers out there still that quote 4 digits, so the smallest variation is always going to be 1 single Peep, okay? So that would be the example. However, in the case of brokers that are going to be quoting 5 digits, as Global Prime does, then a Peep bet can also be accounted for as an option. However, be reminded that the industry standard still uses 1 Peep as the universal measure, okay, to express changes in currency pairs. So in this case, 1.10 with 5 digits, and the smallest variation would be 1.10001, okay? And that would be 1 Peep bet. Okay, that would be the smallest change. However, the industry still going to take into account 1 Peep to refer to the changes in quotes of a currency pair. Okay, so in the case of Global Prime, if we're going to see the smallest percentage, it's always going to be 1 Peep bet. But when it comes to the standards of the industry, you need to understand that change in that 4th digit, which would represent a change of 1 Peep, would still be the most relevant, okay? When, as I said, we're thinking about how the industry has standardized this concept, okay? Now, that being said, we're going to be moving into one more critical area, which is going to be the importance of Peep value, okay? So that's the next natural evolution. Once you understand the difference between a Peep and a Peep bet, now we need to understand the importance of the Peep value, okay? So here we need to ask ourselves the following question. How will 1 Peep change in the quote of a currency pair that we've bought or we've sold affect our trading account? Okay, and here the answer lies in 3 different factors. Number 1 is what currency are we trading? Number 2 is what's our transaction size? And number 3 is the current exchange rate. Okay, so this is the theoretical part that you must totally and unequivocally dominate. Okay, even if I will share with all of you later today a very cool script that does the calculations for you in MT4. This is something that is very fundamental and like the foundational part of you understanding at a holistic level risk management, okay? So remember, we understand by 1, and this is something that I'm introducing as a new concept for you, those that are especially studying as newbies here in the industry. We need to understand that 1 standard size lot is a transaction of 100,000 units. Okay, so let me bring again the painter, and I'm just going to delete this. I'm just going to make a new page. Now, 1 lot, we'll make it bigger, the font size at 36. Okay, there we have it. 1 lot refers to 100,000 units, okay? You need to remember that. Then we have, that's the 1 lot. Then we have 1 mini lot. That's going to refer to 10,000 units. And then we also have in Forex what we call a micro lot. And a micro lot is going to refer to 1,000 units. Okay, now that's the mini lot. Okay, so we need to make the distinction. So we got the lot, then we've got the 10,000 units, which is going to refer to the mini lot, and then the 1,000 units, which is going to be the macro lot. So I was getting confused in there. Okay, so that being said, 1,000 unit, perfect. Okay. So that being said, we're gonna now demonstrate an example using these 3 factors, and for that I'm gonna be, just using again this painter, and here is what we have to understand first and foremost. If you're a retail trader that is going to buy, let's just say 10,000 euro units of the euro dollar. Okay, so we're going to buy 10,000 units of euro US dollar at an exchange rate of 1.10. Let me just expand that. Okay. With a US denominated account, okay, with a US denominated account, you will be paying in exchange 1.10 multiplied by 10,000 units. That's going to be 11,000 US dollars. Okay. Now, if the price then changes by one single Peep, then the Peep value on a lot of 10,000 euro units would be $1 single. And I will demonstrate this. So we have a change of one single Peep. So essentially 1.1001 needs to be multiplied by 0.1, and then 1.10 multiplied by 0.001. That will give you $1 single. Okay, so that is the value of one single Peep when buying 10,000 units. Okay, if instead of, and remember, if instead of 10,000 units you purchase, let's just say 1 million units of euro or 10 standard lots, then the value of one Peep change would obviously dramatically change, and that value will become, so if one Peep change on a 10,000 units is $1, then 10 standard lots, that equals to 10 million. So then we need to obviously multiply that $1 US by 100 times. That'll be 100 US dollars per one Peep change. Okay, so that is the theoretical explanation of how you can calculate the Peep value every single time that there's a price variation on the smallest degree. Okay, and that is a 1 Peep by industry standards. Now, what's important here is the next slide, and that is you also need to determine the Peep value in your currency, in your account currency, I should say. Okay, now it's important that you work out the Peep value of your position in terms of your account currency, as not everyone will have its account in US dollar, for example. Okay, you could have your account denominated and your brokerage firm in Global Prime in Australian dollars, in Swiss francs, in Japanese yens, in Singaporean dollars, etc. Okay, so what this means is that we must perform a very simple calculation to understand what that Peep value that I just demonstrated, being $1 or $100, will be. You need to base that on your currency denominated account. Okay. Now, in a nutshell, you must simply multiply or divide the initial Peep value that we just came up in the prior example by the exchange rate of your account currency and the currency you have transacted by buying or selling. Okay, so here it goes, the example. Hopefully everybody understands. Let me just, okay. So if instead of, let's just say, a US denominated account, you own a euro denominated account, the Peep value would be as follows: a 1 Peep change. Okay, 1 Peep change from 1.10 to 1.1001, okay, in euro dollar. And on a, let's just say, on a 10,000 euro unit. So that would equal to the following calculation, and that is $1, which was the value we came up with before, and that then needs to be, then we need to account for the exchange rate. So 1 divided by 1.10, 0.10. Now this calculation gives us 0.9090. Okay, so that would be the Peep value of that minimal change in your trading account. Okay, or 9.999 euros. Okay, if you were to trade one standard lot of 100,000 units. Okay, so when it comes to, and also remember, when it comes to yen pairs, due to the lower underlying value as a currency unit, which, you know, we all have to be aware that when trading US dollar JPY or Australian JPY, there's only going to be 3 digits. Okay, so as I said, when it comes to yen pairs, due to the lower underlying value as a currency unit, so with $1 at a rate of more than 100 yen, then the industry standards, obviously, as I said, are going to be 3 digits. Okay, so that's why you should not be surprised if the quote in the dollar Japanese yen currency pair displays 110.12. So those 3 digits. Okay, so that's how the majority of brokers will display yen related quotes. Okay, so like this, something like that. So if you were to analyze, for example, dollar against the JPY. Okay, so that's the theory behind how you actually go about determining a Peep value, and then how you can translate that into your account balance. Okay, now that being said, I will introduce a tool in a few minutes that is going to make it much more easy for you to calculate your optimal lot size, and also how you can assess really quickly what are you going to be risking on every single position, especially for those of you that are not so advanced when trading currencies. Okay, so now next slide, we need to talk about another topic that is very relevant, and that is leverage. Now back to the example below. So back to the example that I just shared with you. If you wonder how an investor with let's just say 10,000 US dollars, with 10,000 US dollars account, can control 10,000 units of euros at a euro dollar exchange rate of 1.10, which should obviously cost the trader 11,000. So let's just say that you have an account of $10,000 and you want to buy 10,000 units of euro US dollar at a rate of 1.10. That would cost you $11,000. That would cost you $11,000, but you only have $10,000 in your account. Okay, so welcome to the world of leverage. Okay, leverage is a double-edged sword. You need to understand that as well. Now, if you use leverage correctly, with a degree of, you know, cautiousness and proper understanding of the inherited risk that it carries, then you should perceive the ability to make the use of leverage accounts as a benefit to control larger lots. Okay, and that's how we can control 11,000 US dollars worth of 10,000 units of euro dollar with only a 10,000 US dollar account. Okay, now for the experienced traders, leverage definitely serves the purpose of exploiting one's strategy to maximize returns without the need to put down as deposit the total amount transacted. Okay, now you should also see leverage as the brokerage lending you money, with the trader or the investor only need to put down, as I said, a relatively smaller good faith deposit. Okay, however, and that's where the risk really lies. You must understand that the more units of a particular currency that you're going to be buying or selling, the more your account will be hit by the change of every pip against you. By the same token, it can also increase your gains. but it must be emphasized that what really matters here in Forex is to limit the downside risk. That's the whole purpose of proper risk management. Limit the downside risk. So following the example that I just demonstrated to you in the prior slide, if you let's just say that you choose to trade with a leverage of 100 to 1, okay? So what it means is that the broker will only require a deposit of, so initially we were supposed to spend 11,000 US dollars to own 10,000 units of Euro US dollar. But since we are using 100 to 1 leverage, then we only gonna need 11,000 US dollars multiplied by 1%. 1% is 1 divided by 100, which is the 100 to 1 leverage. Therefore, we only gonna need 110 US dollars to control 10,000 units. Okay, that's how a $10,000 account can control a much larger size. Okay, just don't ever forget that if your account goes through a severe drawdown and the capital in your account is not enough to cover the losses currently incurred due to the excessive lot sizes that you are trading, you're going to run the risk of getting a margin call. That's, you know, at the end of the day, a margin call by a brokerage will occur when the account value, your account value, is not sufficient to meet the broker's minimum value required. Okay, when a margin call happens, the broker's internal risk mitigation system is going to be kicking in, and that's what's known as a margin call event, whereby all positions will automatically be closed and trading will no longer be allowed until the trader deposits again more funds so that the margin account is brought up to the minimum maintenance margin. Okay, so for you to understand, remember that leverage will allow you to control a bigger size of your account, but at the same time, you will be exposed, if you don't control your risk, to margin calls if you cannot meet the minimal requirements. Okay, now next we need to keep moving along. There's a lot of stuff to go through. The FX Peep calculator. Now at Global Prime FX, we have a pretty cool tool, and it's a great tool to assist you with your trading calculations. And let me bring it up to you. It can be found in this link here, globalprime.com.au/tradings/FX-calculator. And real quick, so at Global Prime, we have this little section on the right side panel called FX Peep Calculator. So you can obviously here, first of all, you need to click that you've read the terms and conditions, and then you can start. Let's just say that you have a 10,000 Australian dollar account. You're using a leverage of 100 to 1 as the example previously, and then you want to trade 0.1, so 1 mini lot on the Aussie against the US dollar. And you're going to have a stop of, let's just say, 30 pips. So essentially, this is going to automatically generate how much loss you're exposed to and how much profit you're exposed to, okay? So it's a pretty cool tool, and immediately tells you in the gray areas. The gray areas are the ones that are locked and cannot be changed, and the whites are the ones that you can manually change. So essentially, it's going to tell you right away how much you're going to be risking based on the lot size that you've introduced in this box, okay? So pretty cool tool, if you ask me, and very useful for those that are, getting their feet wet in Forex. Now, the Promise MT4 script. There's a script that I've been using for many years. It is really handy, and I want to, share it with you all. And yeah, so as I said, for a long time, that's been, this tool has been making my life much simpler to calculate the risk position size. Okay, sorry, allow me just to mute my computer, the other computer. Okay, so as I said, this is a script that it's made my life much simpler to calculate the right position size based on a specific percentage risk and the distance of the stop loss from the initial position. So let me bring to you an NT4 platform. Okay, now this is a script that you can find obviously, if I share it with you, which I will, and I'll give you the instructions in a minute, how you can download it, how you can get it. In the left panel of MT4, you can see here 3 different scripts: open long, open short, and prepare stop. Okay. So what I've done is I've created hotkeys. So if you right click and then you select set hotkeys, you will notice that I have 3 different hotkeys selected. If I press in my board on my keyboard Control X, it will generate an open long. If I click Control C, it will generate an open short. But first of all, before I even click Control X or Control C, I want to set up my stop and my take profit. So initially, you always need to refer to the function prepare stops. In my case, the hotkey is going to be Control Z. Okay. So in my computer, let's just say that we want to trade euro-dollar, and I'm going to go to the hourly chart. Okay. So in my computer, what I'm going to do is the following. I'm going to be pressing Control Z, and you'll notice that there's going to be 2 red lines in horizontal positions that are going to be generated. Okay. So from this first press of the button, it has generated 2 lines, as I said. If I were to press it once again, it will generate a 3rd line in a dash line. So what this 3rd line means is that we can opt to enter limit positions. If I were to press again, the 3 lines disappear. So the sequence that follows is always the same. You press the first time the prepare stop. So right now what I'm doing is just pressing Control Z, that's it, which refers to prepare stop. Okay, so it will generate 2 lines. There you have it, 2 lines being generated. If I'm going to then I can adjust. Okay, so if I want to play long, then I can move this line further up, and then my stop, let's just say, place it below these prior lows. Now, if I want to enter a market order without having to wait for price to retrace any further, then all that is left to do is just pressing open long. So in my case, open long is Control X. I press Control X, and then you will see a pop-up window. And in the pop-up window, you just need to make sure that these boxes are being ticked. And in inputs, then you have to just define what is going to be the risk percentage based on your account. So in this case, I have a demo account of $10,000. So let's just say that I want to risk 1%. And you click OK. And then you will be prompted to another pop-up window before, it's just like the confirmation. And it's going to tell you, look, if you want to risk 1% of your account, that'll be $100. So risk 99. Well, is a very close approximation. So 99.41. Okay. So you will be risking 1% or 0.99 in this case. And the reward based on where I've placed my line is going to be 181 Australian dollars, and that gives me a risk reward of 1.82. And the cool part about it is the fact that you can then you can get generated automatically the order size. So in this case, 0.44 lots. So if I were then to click yes, okay, I need to allow live trading. That's why it didn't go through. So let's just repeat again. Okay, now it's been allowed 1%. Okay, now the risk reward is 1.76, 0.43. Yes, there you have it. Okay, so now I have an open position worth 0.43 lots with a stop size about 15 pips and a target of 27. So all the theory that I just went through, this script does all the magic for you. Okay, so in the case of longs at market order, you only need to generate those 2 lines. That being said, if you want to then generate a limit order, then you need to press the hotkey 2 times. So 1 time for the 2 lines, and then the 3rd time. And allow me just to close that first position. So there's no much of a mess. Okay, let's just place the stop below the lows, and then we're going to be placing the take profit around the same level, but then let's just pretend that we don't want to enter this position until the price comes down to the dash line. So all we need to do then is just press the control, the hotkey for open longs, which I've set. Remember, if I come to set hotkey, I've set as control X. So I'm going to press control X in my computer. I'm going to be risking 1%. And now it tells me the order size you can afford is 0.71 based on the 1% risk. You're going to have a risk reward of 3.49 and your risk is going to be 100. Press yes, and there we have it. Okay, now my risk is going to be maintained the same, but my risk reward is going to increase dramatically to 3.41. Okay, so that's how you go about playing longs. If you want to play shorts, then it's the same logic, but here obviously you then need to generate the lines, and the take profit is going to be the line at the bottom, and the stop loss is going to be the line at the top, and then you need just to press open short, which for me refers to control C. Control C, risk of 1%. It tells me that I can afford a size of 0.35. It gives me a reward of 1.89. I click yes, and there we have it. Okay, so now I've opened, you can see right here on the left side of the chart, I've sold 0.35 units, okay? 0.35 lots. So that's how you go about this MT4 script, okay? As I said, it calculates absolutely everything. And if you have a demo or a live account with Global Prime, reach out to me via my email, ivan.delgado@globalprime.com.au, and I will send it to your way. Okay, and I will also share it with the participants at the Discord. Okay, so it's a pretty cool tool that you all can tap into. Okay, just let's keep moving on. There's quite a bit of things to go through, and yeah, I got this slide, but before that, I really want to emphasize that it is really at this point, once I've gone through this MT4 script, that you here need to decide, the risk that you're going to be putting on a particular trade. Okay, don't ever fall into the trap of defining the success of a trade in the number of pips that you're going to be making. Okay, that's a very newbie mistake. What really matters here is the correct position sizing, which this MT4 script is going to help you with. Okay, it's going to assist you in determining the size of your stop loss versus the total amount you're going to be willing to lose. Okay, so let's just say that your account, as is the case in my demo here, is $10,000. Then you must decide what monetary value you're going to be fully accepting to find out whether or not the analysis that you've conducted will result in the price going in your desired direction, or it's going to be an experiment that is just simply going to fail. And you just need to accept the money at risk. Okay, if there is any type of emotional attachment to your position, that probably is a pretty bad sign, and sooner or later you'll start messing around. Okay, so just be aware of that. Okay, that being said, let's move on to the next slide, which is additional risk considerations. Now, this is a very important topic on its own, and I unfortunately cannot spend that much time, so I'm just going to go through it because I still haven't even touched on the 4 pillars that are going to determine, which are going to be making the magic for you to really control your risk when trading Forex or any markets. Now, additional risk considerations that you need to have is you need to set the maximum risk you're going to be willing to accept per day, per week, per month. That's why I mentioned here per set of time. Okay, it's very important. You also must work out your total risk exposure at any stage, okay? And what I mean by that is, how much of a correlation in risk are you willing to be exposed to by trading the same currencies, okay? If, let's just say you're trading Euro JPY long, and at the same time you want to trade Dollar JPY long and Aussie JPY long, essentially what you're doing here is that you are tripling your risk just because you're going short JPY against 3 different currencies. You don't want to do that. And if you do, then you obviously need to somehow find a way to split your risk among these 3 positions, okay? And the 3 positions to manifest one single risk position that you would take normally, okay? You also need to take into consideration how many trades will you open at one time, at any point in time. because at times, unless you obviously use some automatic algorithms, then it's going to keep you off track. It's not going to enable you to focus on all your open positions, and that by itself is a risk factor that you need to account for. Okay, and you also have to potentially figure out some rules to take some time off the screen, or even a whole day or a whole week, to clear your head as a form of reassessment if for whatever reason the proverbial hits the fan and you experience some type of severe drawdown. Okay, this exercise alone, the fact that you can step out of the screen and just unwind, this is going to be priceless for you to kind of like avoid these certain pitfalls that traders fall into, such as like revenge trading or impulsive reactions just because you want to get that money back as soon as possible. These are very, very typical human nature reactions. Okay. All right, let's get into the most exciting part, because I mean exciting because it is going to be of great value not only for newbies but also for the intermediate trader, less so I suppose for the advanced traders. You probably have had to consider this from a while ago. And this is what I call the 4 pillars in risk management. Okay, now risk management, remember, is a game of properly applying statistical or probabilistic techniques. Okay, and while the term trading sounds obviously, as I said at the very beginning of this webinar, much more sexy, much more fashionable and fancy as part of a holistic approach with with many moving pieces to take into account. Trading at the end of the day, just entering the market, that kind of like dose of excitement, knowing that you've entered 1 lot or 10 lots or whatever. There's this more critical part, and it is my belief that the transactions in the market are follow this much larger umbrella, which involves how you're gonna manage your risk. Okay, so therefore making profits in the market in a sustainable manner, let's just say, can be a rather daunting task and unrealistic undertake unless we really understand and take care of these 4 different pillars. Okay, so the pillars include win rate, risk reward, money management, and your broker. Okay, now I've introduced your broker as a critical selection you need to make, and I will get to why that is at the end of this webinar. Okay, now this should be your building blocks or pillars, as we refer to when it comes to your approach trading the markets. Okay, any strategy, mindset state, goal resolution, preparation, whatever it is that you will incorporate on top of your trading arsenal that for whatever reason fails to understand these universal truths that I'm going to introduce today. Okay, because trading at the end of the day is an activity that is so statistically oriented that I cannot emphasize enough. Okay, if you don't apply these techniques then and respect these pillars, you will suffer from voidness at its core. You really are not going to be getting it. Okay, so let me just show you the next slide. You see this slide, this is what I mean by sustainable profits. Okay, what I mean is have an annual equity curve that shows a clear upward slope, as in the case of this slide that I'm showing you here. Okay, it obviously doesn't have to be as pronounced as this one, but it needs to generate higher highs and higher lows over time. Okay, this is what I mean by a sustainable curve or a sustainable P&L over time. Okay, so let's get to the nuts and bolts here. Pillar number 1 is going to be your win rate. Now, as a trader, you must be able to figure out a realistic yet high enough win rate so that when it's combined with the risk reward, that's what will create that kind of sweet spot. You're still going to have to incorporate risk per trade, but this is really the ultimate match. Win rate and risk reward. And here I want to first just focus on the win rate, okay, and how much you will be making how much you're going to be making in a win versus a loss. That's going to be the risk reward, and we're going to touch that in a little while. Okay, but here is really whether or not you can generate a positive expectancy, okay, over a sample of trades that are going to be large enough. And we're going to get into the actual statistical concept, why you need a sample that is going to be large enough for your system to really tell you and to really thrive and show the edge. Okay, now it's really much easier said than done to definitely generate that sweet spot by having that win rate and that risk reward. And I have to say that to achieve such a level of mastery on your results, you definitely must start by detaching yourself from the idea that a high win rate of, let's just say, 70 or 75% will keep you on the winner's side, generating this type of curve. Okay, that couldn't be further from the truth. Okay, that cannot happen unless it is going to be supported by a high enough payoff whenever you are right in your experiments. That's how I like to call it, experiments in the market, putting on trades. Okay, so you know, I can understand the allure of having a very high win rate in your trading. Obviously, at the end of the day, it's human nature wanting to be right and avoid the pain of enduring a loss. And you know, at the end of the day, if you've studied the neuroscience, or you've studied the science of your brain, the intensity of emotions when experiencing a loss, it tends to be much greater. You know, it tends to be greatly amplified as a function of your inherited psychological reaction as humans. You know, and that definitely, you know, that originates from the self-defense mechanisms we've got, you know, we've built over millions of years to escape danger or harmful events. So you really need to detach yourself from that idea. Okay, now, and the next point that I want to make is that, you know, therefore it's really, really important that as traders, we must break away from this mindset of damage prevention. Okay, and we need to start realizing that at the very root, when trading, each outcome is going to represent a constant sequence of random events. Okay, there's obviously going to be a slight edge over time, but on an individual basis, it's going to be just simply a sequence of random events in the market, because you cannot control a whole plethora, there's a whole myriad of issues that you cannot control when trading the markets. Okay, and a great example is just in the last 24 hours. We've had lots of headlines about the US China trade talks. First, there was denial that the Chinese first there was these reports about the Chinese walking away from the meetings in the very first day, and that caused risk off. And then all of a sudden we seem to, you know, have the US considering a currency accord, and that then gets a whole, you know, rampage of demand and a major reversal in the market. So those are the type of events in terms of headlines, risk considerations that you need to have. Okay, so it is only when taking, and that's very important, you know, as part of the win rate, it is only when taking consistently repetitious actions as part of your trading plan, as part of your entry techniques, that, you know, allow you to enter the market through some type of trigger mechanism, you know, that by following your rules, that one can type into this power of what's referred as an edge over a long enough period of trades. Okay, so again, the edge is nothing more than a positive expectancy over a large sample of trades. And what this means is that the mentality of any successful trader and the changes that you must go through really is like a paradigm shift. Okay, one that, as I said, humans, we're not accustomed to. And start thinking in terms of probabilities, not running away from losses, but really embracing them as just part of the game, as part of the statistics, and being at peace with ourselves, knowing that this is just one more single outcome as part of a much broader context of applying a system that with an edge that we can exploit, just because obviously we've done our own due diligence and we've gone through the back testing, and we have the conviction and the certainty that it has provided returns over time, over a large sample of trades. Then we obviously can strengthen that conviction in present time. Okay, and to give you a perfect analogy, I know that it's kind of like cliche and it's been used hundreds of times in the trading domain, but I always like to think about the roulette in the casino, and the house knows that every single spin of the wheel, the ball may end up landing in any random number, okay? But so what it means is that each individual result is definitely going to be rather unpredictable in nature, but it's only when they take into account the number 0, which is going to make the game of the roulette such a profitable game for casinos, because over a large sample of events, the statistic, I should say, will tilt the balance in favor of the house, okay? So that's a type of mentality that as a trader you must have, which brings me to the next point. And that is, in each random sample of outcomes, one can and will go through clusters of good and bad luck. This is absolutely critical for you to understand, okay? You can go through clusters of good and bad luck. And the sooner you accept this reality, the more mentally prepared you're going to be to tackle trading from the right mindset perspective, okay? And notice here that I am dedicating an awful lot on this win rate because it is definitely the most important. And you will understand in a minute the moment that I introduce a more practical example, okay? So talking about examples, let's think about the act of flipping a coin, okay? Which is obviously a mutually exclusive and random event. And it's only got 2 outcomes available. Either you get heads or you get tails, okay? So if you wonder why in the short term such events are considered random despite the theoretical 50-50 chance leading to accumulating clusters of good and bad luck, you really need to understand that there is, as I said, a myriad of uncontrollable factors influencing any outcome in both in the flip of the coin and also in trading, as I've commented a few minutes ago, okay? So in trading, you can include short-term versus long-term technical cycles, the more kind of like conventional technical outlook in each time frame, fundamental events, as I was talking a few minutes ago over the US-China trade deals or over Brexit and the major buy-side demand, buy-side activity we've seen in the pound. We can obviously account for cluster of orders in the chart, etc. And when it comes to flipping a coin, there's definitely also some forces at play, okay? And that can be from the motion of the air in the room whenever you flip the coin. It can be the position of your hand when you catch the coin. There's different elements that are going to be playing a role in a particular outcome, okay? So let me give you this example. In the flipping of the coin, even if the scenario is going to be, in theory, a 50% probability of a coin come up head or come up tail, there's going to be up to 16 different outcomes that you can expect, okay? So if you were to flip the coin 4 times, these are the 16 different outcomes that you can actually expect, okay? Head, 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 tail, head, 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 tail, up to 16 different outcomes, okay? So what this means, and let me just show you the next table, what this means, as this table on this very first table on the left side illustrates, is that in a sequence of events with a 50% probability, we still have a 6.25% chance of going through a cluster of luck, which is either going to be good luck or bad luck. And we can end up with 4 heads or 4 tails, okay? Even 2 heads and 2 tails, which would be, in theory, what's to be expected, still going to be, even if it's going to be still the most likely outcome, it's only assigned 37.5% probability. In other words, in such a small sample of events of only 4 flips of a coin, randomness applies. Randomness is going to apply when you have a very limited sample size, okay? Now, moving on. So the curve that you see right here, which is also something that I show you in the next pictures here. This curve you see is known as a normal distribution or a bell curve. And it's one of the most important tools in statistics and probability theory, okay? And it's so essential to understand for you as a trader. And why I mentioned having a long enough sample of trades. So here's the crux of the matter. The repetitious trials of random events that arise from flipping a coin result on this bell curve, let me rephrase that. The repetitious trials of random events that arise from flipping a coin is going to result on this bell curve. And what do you notice on this bell curve? Well, this bell curve is telling you that over a large enough sample of trades or flipping of a coin, the outcome will tend to be tilted towards the middle point. And the middle point is that 50% probability, okay, that your system is supposed to give you, okay? So it allows you to find out the probability distribution of getting heads or tails, or getting wins or losses over 100 coin flips, over 100 trades, okay? Notice how the distribution in outcomes gets more skewed towards the center of the chart or the bell shape, okay? Something that is known also as the central limit theorem, okay? And this is what I'm showing you here on this second chart. Now, what if we kept increasing in the number of times we flip the coin to just say 1,000 times, or we take 1,000 trades? The more times we increase n, and the n would be the number of trades that we take, or the number of times that we're gonna flip the coin, then the more pronounced the shape becomes with the creation of another universal truth in statistics, that is standard deviations. And standard deviations in layman terms is essentially that for a sample of coin flips large enough, there is going to be around a 68% chance that will result in one single standard deviation. And that's what I've highlighted here in blue. This blue square, this blue box highlights that one standard deviation is going to fall within these parameters. And then we're going to have also with a 95% chance that the outcome is going to be 2 standard deviations. And that's what I've highlighted here in red, in this red box, okay? So the bottom line for you to understand is that a 50-50 random event has a tendency to balance out towards the center of the curve the more the sample increases, okay? And that's assuming that we are flipping a coin, but obviously there are certainly edges that one can find through a mentor, through your experience trading the markets, that can definitely make that edge greater than 50%, okay, for you to find that edge and to exploit that edge, okay? So that's the concepts of the bell curve and how statistics, being universal truths, are going to put you on the winner side, on the right side of the market when it comes to you having a more holistic assessment of your win rate, letting first this large number of trades play out, okay? Now, something else that I want to show you, and just to finalize this chapter, which by far is going to be the one taking up the most time, the win rate. Another key point to take away is that the more samples one obtains, the more it's going to decrease the overall percentage of clusters of bad luck, which is what really matters here. Limit the downside risk, therefore limit the clusters of bad luck. So as I illustrate in these tables, if we were to place, let's just say, only 10 trades, as you can see here, trades is the number of trades we intend to place, let's just say 10, with a win percentage or win rate expectancy of 50%, then the expected maximum losing run for the system would be 4. So that would be the cluster of bad luck events that we are potentially about to encounter, okay? Now, if we were to increase the number of trades to, let's just say 100, then the maximum losing run would be 7, okay? Which is and here is the absolute key for you to remember, which is proportionally much less relative to the total trade sample. So essentially, if we were to divide 4 by 10, that gives us a 40%. If we were to divide 7 by 100, that gives us a 7%. So proportionally, it's much less. So wouldn't you be much more prepared to turn the corner as a trader, knowing that if you allow a sample of trades long enough, it's going to reduce that cluster of bad luck to by 4-fold, by 5, by 6-fold as you increase your trade sample to 100 to 500 to 1,000. Okay, just remember that. That's very, very important. Okay, so next, risk reward. So accepting as true this hypothesis that a system providing a 50-50 win ratio expectancy tends to increase its accuracy towards this base of 50-50 scenario, as I've shown you with the bell curve. You know, as the sample of trades expands, while the clusters at the same time, just as I shown in this prior table, while the cluster of losing trades or bad luck also decrease in total terms. So what would it take to place the statistical odds in your favor to help you achieve consistency on your results? And here is where we welcome the other major component, which is the risk reward. Okay, so this is the answer to the question. We must add into the equation the second pillar, and that is, you know, what goes hand in hand with the win rate. That's the risk reward. Okay. The term risk reward refers to the amount of capital that you're going to be aiming to make relative to how much you're willing to lose in trading. So essentially, if depending, let's just say that you depend on a strategy that it's going to get you a win, a consistently high enough win rate of let's just say around 50% or slightly above, then the closest thing that you can get to Holy Grail is that you match that up with a high enough risk reward. Okay, and I'm going to provide you a few tables that will help you understand that. Okay, so here the key, and there's a pretty well-known mantra in trading that I've always endorsed, you know, and have, you know, this mantra or this adage has also been endorsed by the most legendary traders, and it does make sense from a statistical standpoint, and that is, let your winners run and cut your losses short. And to me, that is the ultimate truth, really, like part of the equation that makes that sweet spot as traders. Okay, so it should be immediately obvious to you why this simplistic yet effective quote of letting your winners run and cutting your losses short has so much power behind. Okay, in a few words, that statement encapsulates like no other what this second pillar is all about. Okay, now if I were to show you this next table, speaks volumes about this concept. Let's just say for a second that one aims for a risk reward of 1-to-1. In other words, as an example, you win 200, as the table above shows, you win $200 on one trade, or you can lose $200 on the trade. So essentially, you must be right no less than 50% of the times to keep your head above the water and make money in the markets. Now, if you were to opt for winning $400 or losing $200 on every single trade, then that gives you a risk reward 2-to-1, which means that you will only need a 35% win rate to allow you to statistically make money. Okay, and the tables here prove that that truth. Okay, now the next table here that I show you is also extremely valuable for you to keep in mind. So the let's just ask ourselves, what's the key then? You know, because there's no right or wrong approach. You know, as long as you're able to find something that I reiterate, your sweet spot. And here is what it boils down to. Your sweet spot is got to be one that is going to balance out the win and the risk reward ratios, that something that can ultimately result in a positive expectancy. Okay, a higher win rate is going to allow you that wiggle room to afford a fairly low risk reward. But if in this example that I show you here in this green table, your system expectancy achieves, let's just say, a 50% win rate, then you obviously must adjust your risk reward accordingly. Okay, so what are these adjustments? Okay, exactly. So we can find out through this table, by checking this table, we can unpack the absolute minimum requirements depending on the combination of win and the risk reward ratios to be, at the bare minimum, a break-even trader. So let's just say that you aim for a one risk and one reward. So a 1-to-1, you need a 50% win rate for you to be at least a break-even trader. What if you want a 2-1 risk reward? Again, you only need a 33% win rate. If you want to risk 100 and win every time 300, then you only need, believe it or not, a 25% win rate. So again, it is preposterous to think that a high win rate alone is going to achieve much for you, for your ultimate purpose of being a consistently profitable trader. Okay. Now, by the same token, if you're going to be risking 300 and only want to win 100, which is going to guarantee potentially a higher win rate, you need to have a win rate of above 75%. Okay. So remember this concept. It is massively, massively important. Now, what do you see in here? This is a chart that will help you to also visually observe how the need to be right in your trades is going to decrease in proportion to the increase in risk reward that you're going to be adopting as part of your trading approach. Okay, so finding again your sweet spot is a journey of self-discovery. Okay, I cannot emphasize that enough. It is through trials and errors, through that path that you undertake of self-discovery, of making an awful lot of mistakes, but that you can reinvent yourself into a better trader. And most importantly, you can remove the toxicity of those mistakes being repeated over time. That will recalibrate your approach and help you to find that sweet spot. Okay, so as I said, it involves trial and error, it involves experimentation of different hypotheses that are going to ultimately back you up with, that will ultimately back up the empirical data that you've collected. Okay, and that will allow you to make the assumption that your system will need an X percentage of accuracy rate, and then based on the risk reward that you assign, then you just have to work out the maths and obviously let a long enough sample of trades based on that bell curve that I just mentioned. Okay, that's really, really important. Next, something that I want to mention is the risk per trade and the risk of ruin. Okay, now nothing what I said or share until this point will make much of a difference or will be of much practical use unless you're going to treat with respect this little, as I call it, little demon, which is called the risk percentage. Okay, you must develop a sense of control and almost obsession towards the management of risk per trade. Okay, otherwise the first two pillars are going to be win rate and risk reward are going to be most likely dead in the water. Okay, so if one, however, finds the sweet spot as described earlier, and on top of that, then you include a risk level that is within limits to avoid the risk of ruin, that's when we finally go full circle, or almost full circle, because we still have to make the right broker selection. We can go full circle in creating what I call the virtuous cycle, and by far the most sacred foundation that any serious trader must abide by. Holy Grail, forget about trading strategies. Holy Grail, really, win rate, risk reward, and respecting risk and risk of ruin. They're really respecting these four pillars, really. Okay. Now, what exactly is this risk of ruin formula? Okay, and I have to say that credit where it's due. This is something that I've pulled and I've learned from Chris Capri, the founder of Second Skies. And I'll show you later a calculator that will help you to determine your own risk of ruin, okay? So again, first of all, credit to Chris Capri. I've been following his content, the stuff he puts out for a long time. Now, at its core, the risk of ruin is a statistical model that is going to calculate the probabilities of blowing up your account. That's it, pretty much. You need to find this is where you need to really find your sweet spot as well, okay? How can you combine win and risk reward ratios to an extent that the level of risk you can afford per each trade is such that you essentially nullify the probability of losing your account, okay? So let's just say, for example, you obviously, when looking at these tables, you need to find the right combination that is going to give you 0 or something that is very close to 0, okay? For example, what if I am risking, let's just look at this first table, which is definitely very, very aggressive, okay? In this first table assumes that you're going to be trading 10% risk, which is insanely high per trade. So what you need let's just say on a 50% win ratio and on a 2-to-1 risk reward, you would think that this is going to actually keep your account, essentially the risk of blowing your account to 0. Well, it's not quite 0, that you still have the chances of blowing up your account just because you are risking way too much on one single trade. And that means that you can accumulate clusters of bad luck in trading, okay? So essentially the very minimal combination would be for you to go 60% win rate and 3-to-1 risk reward. That's why it is just so risky for you to even consider 10% risk per trade. Now, that being said, if we were to reduce the risk per trade to 2%, here's what I highlight, 2% risk per trade, the table then skews much more, it's much more cautionary, this approach. And this is being reflected by the zeros displayed in the table. So essentially, this is telling us that on that 50% win ratio with the 2-1 risk reward, the actual statistical chances of blowing your account are 0. Now, if you were to go for a 50% win ratio and a payoff of 1-to-1, you can still blow your account. You can actually have that 100% probability of blowing up your account if that is the combination that you choose. That being said, if you just provide to your strategy that small edge and you go for a 55% win ratio and you still keep a 1-to-1, then essentially you bring down the chances of blowing your account to 0. These are ultimate truth. These are models that casino actually use to guarantee that they still going to be running a profitable business, okay? So bear that in mind. And something that I want to show you, yeah, here we go, is the risk of ruin calculator. And here again, I want to show you a second. Yeah, so I want to show you this website, secondskiesforex.com/risk of ruin calculator. Here, essentially, what you can do is you can introduce, a second, risk. Here, essentially, what you can do is just introduce the accuracy, right? Let's just say 50%. How much you're going to be risking, the payoff risk, just say 2, and it will give you the risk of ruin. You want to aim for 0% here, okay? So let's just say that I want to get a risk reward of 1, win rate of 50%, and I want to risk 3%. The risk of ruin is 100%, as you can see, okay? So it kind of like, it matches what I just show you on that table, okay? So again, you really want to find your sweet spot through the combination that will give you essentially a 0% chance of blowing your account, which is demonstrated through a result of 0 here on the risk of ruin, okay? So let's go back to the slide. The last pillar, a broker that you can trust. And as very much as I mentioned in pillar number 3, which is you can just throw out of the window the concepts that I taught you today, unless you're going to define, you know, the risk per trade and then find that sweet spot. Same can be applied and throw everything I said out of the window, you know, about these 3 pillars, unless you find a broker that is going to be on your side, one that is going to provide a service that is catered to your needs along the way, no matter what. Okay. A broker that really provides an unparalleled customer support and is transparent, as transparent as humanly possible. And, you know, at the end of the day, this is going to be your companion. You know, without the right companion in your journey to becoming a successful Forex trader that respects these pillars, then this virtuous cycle will fall short. You know, and that's a cruel reality of the direct conflict of interest between many of the brokers out there that run a B-book and the trader and the trader himself. Okay, so if a broker profits from the losses of the clients, then you're definitely not taking sufficient care of one vital pillar. Okay, and I'm very proud of it, and part of the reason why I decided more than a year ago that I wanted to take on this journey as, you know, playing a role here at Global Prime, not only because I've been a client for a long period of time, but also because Global Prime, it really defines, it represents the echelons of all these principles. Okay. Here we align our interest with yours, okay? And we actually provide trade receipts that show which banks fill your order. So obviously that conflict of interest is non-existent. And, you know, we are one of the only brokers in the world that's going to go the extra mile to such an extreme level of transparency as like providing you the receipt if you so need it. And our execution services can also obviously be suited to clients' particular strategies by applying lightning fast execution, almost near zero slippage, and you know, pretty deep pools of liquidity, and tailor, most importantly, to stream also the institutional traders. Okay, so again, besides that, and something that I also want to mention is that the community that at Global Prime we aim to create with our clients cannot be sufficiently overstated. And that's why we make ourselves available around the clock to serve you at the best of our abilities in any questions you may have, which is definitely still also part of the risk factors that you must account for. Imagine that for whatever reason you are running a position and your computer, you have an outage in your house and you need to, you know, request assistance from Global Prime. You can just give us a call. Customer service is going to be available to you. We can manage, you know, and we can mitigate certain risk from the client side. Okay, so we are always open to hear also feedback to continuously improve the quality of service we deliver to our clients. Okay. So that's a very important pillar that you must consider. Okay, so that's really, really key. And to wrap things up here, I hope that you know, so far you've gained plenty of value from this Forex risk management topic that I've introduced today. Kind of like as a conclusion, before you start trading, if you're a newbie, if you're intermediate, obviously just get the most out of today's content. Just select what resonates most with you. Just first of all, you should have this impeccable grasp of how much you are risking in each and every single trade. That's super important. And it really all starts by coming to terms about, first of all, what I've introduced to you, which is the theoretical understanding of, you know, how much pips are you risking and how much value each pip represents, and also to make sure that you've taken care of these 4 pillars that I've introduced today. Okay. And something that we do strongly encourage at Global Prime is that you practice in a demo account first, you know, just to get used with the proper inner works of the trade size that you're putting on. As I said, the peep value, find your sweet spot as part of these 4 pillars described. And only when you're fully in control and comfortable, then you can consider the next step in your trading journey. Okay. So those are all the nuances or the details and the major building blocks that will definitely limit your risk as a trader. And yeah, I don't see any questions in the chat box. If that is it, then I will wrap things up. It's gone on for about 1 hour and 15 minutes. I was really expecting this webinar to be pretty long, but you know, hopefully I've hit all the angles that you may have expected as a really comprehensive and detailed approach when it comes to risk management. Okay, guys. So that's all I wanted to share with you all today. I hope that you've enjoyed the webinar. It's going to be made available in YouTube by Monday, the latest. And I will share also this little script on the Discord room. And if you're not a client of Global Prime, either a demo or have a live account and you're not part of Discord, you can reach out to my email address, ivan.delgado@globalprime.com.au, and I can share that script with you if you do register to our Discord or register to a demo account at least with Global Prime. Okay, that's all for me. Thanks, folks, and I'll see you in the next webinar. Cheers.